What's the point of doing a press conference every time starting next year? That was also part of the news today.
Well, they said this previously, that the market is so conditioned that you can only move at the quarter-end meeting and just make it a bit less clear. So, I mean, I don't think they're trying to send a strong message, but it also goes in the hawk. No, I don't.
That's what they did in the past. Like going back to 2006, they would raise a quarter point every meeting, every 6 weeks, right?
That's right. And I mean, that is a possibility if we do get upside inflation surprises relative to their forecast. I mean, I think they will probably do a little more than what they're saying at the moment. They moved to 4 hikes for this year in total. That's consistent with what we're expecting. For next year, we're expecting 4. They're still at 3, but you know there's risk in both directions. So it's certainly possible that they would actually want to go more quickly, but it's going to depend on the data, not on the schedule of press conferences.
And Mike, I thought the market reaction was interesting. It kind of was no reaction, then a little bit of a positive one, and then we dumped 119
Which
at the close.
does sometimes fit the pattern. I mean, the market seems to have to assimilate it a little bit. I thought initially the response to Chair Powell's press conference was generally upbeat, if you look anecdotally. I mean, he keeps hitting this message. We're not afraid of frothy financial conditions. We don't really see an overheating problem. It's just the economy's better. And this is our response to an economy moving in the right direction. Do you think that message will continue on for coming months? We're going to find something to worry about in all this? Or?
No, I think that will be the message for the next few rate hikes still. I mean, one other thing that he said that was interesting was that, you know, policy is still accommodative. They didn't change that statement. He was asked about it and sort of suggested that we're still a ways away from actually removing that language. I mean, eventually it's going to go, but it doesn't seem like it's imminent. So the next few hikes can still be basically packaged as economy's better, so we're normalizing. At some point, you know, you go beyond what you think is neutral, and then that's a slightly more difficult communication job.
Is it time to change the target, the definition of success, which right now, frankly, revolves around the inflation rate? Does it need to revolve more around GDP and how fast that's growing?
Well, it is a dual mandate. I mean, I think sometimes they emphasize more one side of the mandate, sometimes they emphasize more the other. But I think it is always important to make clear that you look at both sides.
But you've got Summers out there saying they should just target nominal GDP, and that rates will always be this low, basically, if they maintain the status quo.
Well, I think my own view is that for the time being, in this kind of environment, the current framework looks pretty good. And I think Powell was in agreement with that. There were times back in 2011 when I think it would have been a good idea to, you know, target the level of nominal GDP, at least for a temporary period. So that's sort of consistent with what former Chair Bernanke said, that there are times, exceptional circumstances, when you might want to deviate from the current framework. But right now, I don't think it's really broke, and so I don't think it really needs fixing.
You know, there remains all this focus on the shape of the yield curve, the fact that between the 2-year note and the 10-year Treasury, it's about 40 basis points. Now, that's wider than it was for most of 1997 and 99, 2005 to 2007. Is there something to worry about there? Does that limit how much the Fed can do ultimately?
I don't think so. And again, this came up in the press conference, and I think Powell gave relatively short shrift to the idea that the yield curve in and of itself is something to worry about. He really phrased it more, or couched it more, in terms of this being a consequence of them moving the funds rate higher, and that's the way we would look at it. So I don't think that a flat yield curve or even an inverted yield curve causes recessions. I mean, it's the sort of thing that typically you observe later in the business cycle, but I don't think it's a sort of independent signal that the economy is bound for a sharp slowdown or a recession. So I think the outlook still is pretty good, and that's, I think, the message from Chairman Powell as well.
All right, 4%. Is it possible we're going to do 4% this quarter GDP? Or
it's possible. I mean, we're not quite there at our own tracking, but it's not far away. This quarter is going to be probably a lot stronger than the 2.2% in the first quarter. But obviously, quarter to quarter, these numbers jump around a bit.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.